Hi, fellow investors. Hey, this is Ken Renner, real estate broker, real estate expert in the North Austin Metro, Liberty Hill, in North Austin to be exact. And I thank you for taking your time to watch this short podcast in regards to how to protect your income and also how to build a state through not paying as much as as the government would like to see you pay in income taxes. So we're going to talk about a lot of different strategies with tax shelters. We're going to be talking about things that you probably never heard of and that I didn't hear of. Even one of the strategies today, I just found out, I'm learning every day. I've been in the business, real estate investing for over 40 years. Sold over $500 million in closed real estate. And I want to introduce to you my financial advisor's CPA. It was recommended to me by my financial advisor because my current CPA was fortunate enough to retire. But then I was left with I needed to find a tax advisor as opposed to just a tax CPA preparer. So most of my clients are high net worth people from high net worth individuals and couples from Bay Area and West Coast, East Coast that are buying investment properties through me. And so they really need to have the help of being able to navigate the complicated IRS rules and strategies and the changing things that have come up, including with new political environments coming up potentially of how that's going to affect your position as and your taxes. And we talked about before the podcast with King here is that I said that my parents told me that it's not what you make, it's what you keep. So I enjoy helping my clients make a lot of money, but you know what? If you're giving up too much of it or a portion of it that you shouldn't to the IRS and the state of California or wherever you're at, this is going to be a great podcast for you to listen to. So I'm going to let King, CPA and also a double PhD, introduce himself, and then we're going to start talking about how we can help save you guys some money on your taxes.
That's it. Thank you, Brother Ken. I truly appreciate it. So, to all of those that are listening and or watching, my name is Dr. King McCray. I am the CEO and co-founder of the Accounting Lab. We are a full-service tax and advisory firm, and I think the key word there is, that Ken hit on is the advisory side of it. Okay, so we're not just tax preparers; we're actually tax strategists, master tax strategists at that. As we all know, there's about 77,000 pages in the tax code, and most people don't want to look at that information, but that's exactly what we do. So just really quickly highlights on my background, originally from Lansing, Michigan, currently residing in Orlando, Florida. We have 4 offices spread out all over the Southeast, looking at opening up another one here soon. My background is primarily in finance, accounting, and also wealth management. A serial entrepreneur owning multiple businesses. As Ken states, I do have 2 PhDs, one in finance and one in business. So I'm a little bit of a nerd. I love this stuff. I love numbers. I love helping people make money and all money. So it's an absolute pleasure to be with you all and to give you as much information as I possibly can in the time frame that we do.
Thank you, King. How's the weather in Florida right now?
The weather is not too bad. It's rainy season. We have our spurts, 15 minutes here and there, and then hey, we're moving on. So it's not too bad.
Interesting, because I just opened up the Florida market to my clients, so we're out there all the time now, all over Florida, because Texas market's great for what we're doing, the build to rent type of properties, but Florida is another lucrative market, and I get an excuse to go out and put my toes in the sand, or at least bring my wife and let her put her toes in the sand.
That's
So
it.
yeah, so one of the things that we got connected with is because one of the things when we had a first conversation was that you're really good at looking over the horizon, what the potential of what the political environment, the laws that can change, and things like that, of knowing when these changes are going to happen potentially, and what would be the ramifications. And so we're going to go over a little bit of that. But tell
Yeah.
me just an overview with depending on which administration gets in there, how do you think it will affect? Obviously, Democrats want to get more taxes from us, and obviously,
Mhm.
Republicans want to but keep more money in our pockets as far as business owners. So, tell me what you think is going to happen if, depending on which way the election goes next year. But how will that affect
I
you?
mean, that's the biggest thing that we have to look at because we also got to take into account inflation as well. So inflation just recently, obviously there was an earmark transition that happened here. What was it, like 2 days ago, right? The Fed came out and said, "Hey, we're not going to move rates right today,
Right.
but it's a possibility we'll start to scale back." Well, when you do that, you saw the market start to go up, right? Everybody was happy about that. I still believe in an inflation market that we're in. Market right now is probably still a little overpriced, right? I don't want to get too deep into the weeds there, but I definitely think it's overpriced. We're going to have a scale back again at some point on the market. But depending on the administration, as you just stated, the Democrats want to obviously have more taxation on the 1% of the world, right? The more wealthy. Whereas the Republicans are saying, hey, let's all kind of be equal as much as possible. I made what I make because I'm out here working hard and this is what I do.
Yeah.
So there is going to be a change of power that goes one way or the other. You know, at the end of the day, no matter who's going to be in the office, the thing is the individual themselves needs to make the decisions for them, right? Go ahead and start building those different tax strategies and put those in place. No, so you can be prepared for whatever direction it goes in. Because let's say that, you know, Democrats get back in the office and obviously we have more taxation. You know, let's say inflation starts to kick back a little bit, but then you have the opportunity to invest a little bit more, right? You got more opportunity there. Obviously, with the BOI regulation that's kind of out there that some people want to get into with, you know, knowing about whether they are the business owner or not, right?
Right.
Some states are saying, hey, we don't want to put that information out there. So, you know, let's scale back on that. We just have to be prepared for whichever direction the country is going to go in by putting in place the right strategies no matter what, because
So,
one may be more favorable versus the other.
yeah, and so there's a lot of different legislation that is going to expire in the next 2 years that we
Hmm.
need to be aware
Hmm.
of. It affects estate planning. It affects everything that we do in real estate. A lot of real estate potential changes. But so we're going to get into those the nuts and bolts of kind of a quick rundown of the key areas of tax strategy where we can save money when it comes to selling, buying, exchanging real estate. So the
Hmm.
first one is oh, by the way, first of all, I am not a tax advisor. I cannot give tax advice. I cannot give legal advice either. So I give my little disclaimer there because I have a tendency to say too much. And so I just want to let you know that King is a tax advisor and he can give you the advice that you need. So there you go. And I highly recommend you, if you're looking for a tax advisor who knows the laws nationwide. I mean, you do work with Californians and everything all over the nation, right?
That is correct.
So that's really important because in this day and age, a lot of times you get a tax preparer that just is preparing taxes and doesn't have all these strategies in place. So the first one is the 2 out of the last 5 year rule. So go ahead and tell me about that one for primary residences.
Yeah, so the big thing about the eligibility test, you have to be in your home at some point in time within 2 years out of the last 5 years. And I'm actually working with a client on this literally right now. We had an email about it this morning. So he wants to go out and sell his primary home, but he says, hey, I also have another home that I was in that was my primary home 2 of the last 5 years.
Mm.
I only owe 450 left on it, but it's worth about 1.2 million. What can I save there, right? Obviously, being married, you can save that $500,000. As a single individual is 250. But what people fail to realize is that it doesn't necessarily have to be specifically 2 years consecutive. It can
Right.
be 2 years at any given time in that 5 year mark. That saves you on that capital gains. And then you have other opportunities in there, which if you have the right strategist and we can do it within the right time frame, you also have the ability to use what proceeds are left over on that profit to transfer through what's called a 1031 exchange. So
Mhm.
there's multiple layers, but we have to be careful because there are some exceptions to the eligibility test. Some people feel like they can use raw land as a 1031 exchange, and that's not something that you can do. Some people feel like, hey, I'm about to go through a divorce, so let me get it done now. And you know, if there's a separation or divorce decree in there, you know, you're not going to be able to escape that opportunity.
Right. So you can actually combine the 2 out of the last 5 years if you do it right with a 1031 and really not only avoid the $500,000 capital gain, but also if you're married, but also exchange the difference into more investment property because it was an investment property. So definitely
That is
get with
correct.
King if you want a more strategy on that. Um, so talk about the typical 1031 tax deferred exchange that we all been using for years and kind of the rules and the timeframes on that.
Yeah, so I mean, the biggest thing about the 1031 exchange that you need to realize is it just has to be a like kind transfer, right? I think that's where people fail to realize the biggest pieces there. As long as you have a like kind transfer between the two properties themselves, then you can take whatever proceeds and just roll that right into another property. That literally can be done over and over and over again.
But a like kind property doesn't have to be a single family for a single family. It can be it's
It
investment
does not. It
property
can
for
be
an investment
commercial
property.
property, investment property.
Right.
That is correct. Yes. Yes.
So we have a lot of people that are they've made some great money in the equity buildup here in Austin, and now they're wanting to, what do I do with it? And they can double down or triple down by selling the property, doing a like-kind exchange to 3 more properties or a duplex or a fourplex out in Florida, in Jacksonville, or wherever we end up finding our
Right.
properties. So what's the
That's correct.
times on those?
So timeframes, it has to be identified within 45 days, and then it has to
What has
be
to be
purchased
identified
within 180 days. The new property that you're looking for.
from the day
So
of
the new
closing?
property itself has to, on the day of closing, correct? Yes. So it has to make sure that it's identified within 45 days, and then it has to be purchased 180 days thereafter.
And the money that comes from the proceeds of the 1031 has to go into a qualified intermediary, correct? So
That
if
is correct.
you
Yes.
touch the money, it's taxed.
That is correct. If you touch it in any particular way, then it is going to be taxed. So again, it's very similar to a 1035 exchange, which is done through insurance, right? It can't go directly to you. It has to go from one source to the other source. At any point in time, if it touches you at any given moment, then you will be taxed on that as
And it's
ordinary income.
it's pretty heavy. Ordinary income and
Oh
depreciation
yeah,
recapture. I mean, it could be over
absolutely.
50%. So that's
It
why
could be a brutal hit for you.
you don't want to do anything until you talk to a tax advisor when it comes to doing a 1031 exchange, or if you're going to be selling a primary residence that has a huge capital gain in it, because you want to do it right. And so,
Yeah, Ken, and let me hit on one additional point when it comes to capital gains because there's an additional 3.8% of net investment income tax, right? Net investment tax, the NIT tax, that a lot of people don't realize. So depending on how much money you make, not your capital gain could exceed the normal 20%. It could actually be 23.8%, and that 3.8%, almost 4%, can make a huge difference.
right, absolutely. I didn't know that. See, that's why we have these podcasts. And so we're also going to do a webinar, so that live webinar coming up in a couple of weeks, so that you'll be able to ask and answer, have King answer any questions when it comes to your particular situation. We also highly encourage you to connect with him and get with him on a phone call if you have some situations like our client that you had just spoken with has multiple properties. A lot of them are depreciated out. He wants to get his depreciation going
Hmm.
again, to get more write-off. He wants to do it right. He doesn't want to get caught with capital gains, much less the long arm of the California tax advisors or tax codes.
Right.
So talk about a little bit about the depreciation and how it works. For the 27 and a half year, and the commercial being what, 39 years, 30. So
Hmm. So the biggest thing that I want people to understand about the taxation, or excuse me, the Section 179 expense or
we'll talk about
deduction there.
depreciation in general first.
Okay, yeah. So standard depreciation, right? So on a mortgage, you're gonna have, or excuse me, on a primary home or a residence, you're gonna have 27 and a half years. On a commercial property, you're gonna have anywhere between the same 27 and a half up to about 38, 39 years that you can actually utilize for that depreciation. There are opportunities, obviously, to depreciate bonusly, right? Bonus depreciations are there. But the key thing is most people don't even know that their home can be depreciated, right? Or that property, that additional value that they have can be depreciated. That boat, right? That additional car, all these various things that you have can be depreciated because it is an actual depreciating factor.
Right. And so basically just taking the value of the building and dividing it by 27 and a half years, and you get that every year. So let's say it's a $200,000, let's say $270,000 building, that you would be able to, over 27 and a half years, get about $10,000, $12,000 in depreciation.
10,000 per year.
Yeah,
Hmm.
10,000 per year. That offsets any of the passive income that's generated, right? So if you're in a positive cash
That's
flow
correct.
situation, that'll shelter that. But also
No capital gains though.
doesn't help with capital gains. I know that's something I learned the harsh way. So, but that's okay. Funny about people having to pay capital gains. We don't want to have to pay capital gains, but the thing is, people go, "Wow, I made all this money and I got to pay all these taxes." I go, "Didn't you buy the property to make money?" I mean, it's like, you get taxed on your income, you're making money, so, they feel like they're losing money even though they're having a huge windfall.
Correct.
So the depreciation is a paper write-off. And if you make over 150,000 a year, my understanding, you can correct me, that you can't really, the taxpayer can't take that depreciation to offset ordinary income. So, and most of our
That's
clients
correct.
make over 150,000 a year, but it doesn't go away. Tell us about where does that depreciation at $10,000 a year to get stacked up in the property, where does it go?
So honestly, it's so from various ways that you can set this up, right? It can essentially just sit there because it can be rolled over into future years, right? So it can be a net carryover. There also are section 179 expense and deductions of 1.16 million. So this can be gathered over time. Okay, it can be gathered and set on, depending on the passive activity, or if you even want to utilize it in that given year. But it is a net carryover that can happen continuously on, and you can use it in a specific year that you actually want to use it for. So if there's no need to use it for the first 5 years because there's nothing there, continuously roll it over and then use it when your income has gone higher. That's the beauty of
Right.
it.
Yeah, we just had that conversation with my financial advisor, Wes, because it was like, do I use it now or do I wait for bigger income years? I mean, we had some monster years in the last, during pandemic for what we do.
Yeah.
But you use up your depreciation and you don't have it for later on. But also the thing is about the
Hmm.
people that make over 150,000 a year. Some of our clients make 5, 6, 700,000 a year. If they build up a portfolio of properties, let's say they have 10 homes and throwing off $10,000 in depreciation every per property each year, that's 100,000 in depreciation that they can't use because they make too much money, but it gets stored up in the
Hmm.
property. So when the property's paid off,
Hmm.
let's say they're 70, 75 years, the loans are paid off and everything, all of a sudden these properties throwing off 2 grand a month net positive, then that's 24,000 a year. You can use all that stored up depreciation to cover the positive passive
Hmm.
income, correct?
That is correct. It's simply just offsetting. That's all it is. It's offsetting the income that you're making throughout this time period versus having it to be used and then it wasn't actually needed, right? So
Right.
that's the of having it, right?
Yeah. Then Section 179 throws another layer on it because that's the accelerated depreciation that you can use on all kinds of different assets, not just houses and properties. But
Hmm.
tell us about 179 and what that does for, like it did for me, save me a ton in taxes.
Yeah, so the Section 179 is this it's truly a beautiful opportunity that we have if we have actual tangible items that we can utilize, right? Car, boats, trains, planes, the whole 9 yards, right? So let's say, for instance, with that boat, right? Let's say you go out and buy a boat. Well, if you own a business, you can rent that boat back to your business, not only depreciate it from that one side of it, but you can earn additional income off of it. Or you can have a tax-free reimbursement from your company into that, for that boat for using it, and it's yours personally. You own it. Okay. The beauty of the bonus depreciation, which hopefully, because we were talking about legislation earlier, they're talking about bringing that back at 100% and then rolling that back all the way to
Oh, wow.
2022. That would be beautiful, right? But
Oh,
if we could scale that all the way back to the end of 2022, be able to utilize that 100% bonus depreciation because the laws are sunsetting in 2026. So new laws, new taxes are going to come at that point.
you just brought up something that is really important to me. When will we know about the 100% and the rollback?
So, the legislation has already passed the House. It's currently inside of the Senate. It just hasn't been voted on yet, right? That could happen any day now. It just hasn't been voted on. So that's
So,
what we're waiting on.
so you're going to call me and tell me when that happens, right?
Absolutely, without question.
Okay. Well, because the reason is that 2022 was a monster year for us, and I depreciate. I did a cost segregation on 2 properties, but I didn't do it on enough to cover the whole net. So there could be
Hmm.
actually potentially a refund, or you said it was 100% chance of an audit if I do that, right?
So that's the thing. Yes, if you do go back and amend any returns, that is the reality of it. There's a 100% chance that there is going to be an audit now, but that's the beauty of working with a professional, right? Somebody that knows what they're doing. Our
Right.
audit rates are very, very low, right? We do over 10,000 tax returns a year. We get less than maybe 5, 7 audits a year, right? Less than 5 to 7 audits a year. So the good thing is we still get them. That's right. You should at least still get them because you want to know how to perform in them.
Right.
But 9 times out of 10, it's an easy desk audit. We can just knock it out really quickly.
So the bonus depreciation really is basically taking the government. What 2018 came with the Job and CARES Act, allowing
Hmm.
investors like me to accelerate the depreciation on
Hmm.
instead of 27 and a half years, we can take anything as less than 20 years and take it
Hmm.
on depreciation schedule and take it that first year.
Up front,
So
yes.
last time, and so I did what's called a cost segregation, and it cost me a couple grand to do the cost segregation, but it threw off 70 to $80,000 in passive write-off, which
Hmm.
saved me. My tax advisor told me I'm going to have to write a check for 155K for the IRS. And I said, what can I do? He didn't really know. Found out about cost segregation. Ended up doing two houses and accelerated depreciation on the two houses, and I went from 155,000 liability to 30,000 liability. So,
Right, right.
um, but the
But
reason,
a key point though, Ken, just really quickly, I just want to let people know that obviously if you do ever sell that property, as you know, right, we got to do a
yeah,
bonus recapture.
right.
Okay, so
So,
we want to be mindful about when we do those and strategize that properly.
right. So what it is, y'all, is the depreciation can be the government wants their money if you sold the property outright. So they're going to want the money, the benefit that you got from the depreciation on your write-off. They're going to tax you on that, but it's at a lower tax rate, right? Than your
That is correct.
So it's a 25% as opposed to whatever your ordinary. So if you do have to liquidate, you have to realize that that's going to be part of the tax bill when you head out. But we don't usually do that. We 1031 and can 1031 to the day we die and not pay any taxes.
Keep on rolling.
So one of the things that we really started tapping into with our clients is the real estate professional designation that you can take on your tax returns, which allows you to accelerate this depreciation and protect, if it's done right, the your ordinary income. So my ordinary, because I'm a tax professional, my ordinary income was also I had a deduction, be able to actually bring my adjusted gross income down and not have to pay taxes on a huge amount of income. Now you can't do that if you make over 150,000 a year unless one or the other spouses becomes a real estate professional.
Real estate professional.
So it doesn't necessarily mean that you actually have to have a real estate license, but that does help. You got to prove to the government that you are working actively in real estate, and King will give us those rules there.
Yeah, so there's a specific test for that, right? For an REP or real estate professional. More than 50% of services in real estate, whether it be property trades or business, you have to perform 750 hours as well, and then you have to have the material participation in that activity. Those three things are the test to qualify. But the major point is documentation. You
Right.
have to have documentation, clear documentation that shows that whether it's an Excel spreadsheet, workbook, whatever it may be, if you keep that documentation of your hours and your material participation, the rest of it is easy.
Yeah, exactly. And that's easy to do, kind of like keeping track of your miles. I'm sure there's an app for that that you could do that you could use to keep track, or just a spreadsheet.
Hmm.
But like this 1 hour, if this was an hour education, that would count for the research and education part of the
Correct.
750 hours, right?
Yeah, and we actually teach people how, hey, if you're going out of the country on a personal trip, but you're going out there to look at property somewhere, add that time in as well, right? It's still something. Not only does it become a business travel write-off, right? We
Yeah,
want to get those,
yeah.
but you also are getting your time in for actually going out and researching the property. So it's research, development, training, education, all of those pieces collectively add up to those 750 hours.
Yeah, when we go to Mexico, and we always go to a timeshare, though we will never buy a timeshare, but we count those hours in. We
Yeah.
you know the either the trip part of the trip and the meals can be written off as a real estate
Hmm.
professional. There's so much advantage to it, and the point is that one spouse or the other can become that professional, right?
Hmm. That
So
is correct.
that's kind of the doctor rule. Maybe the wife is a doctor and the husband stay-at-home dad, or vice
Hmm.
versa. The
Hmm.
they both may have degrees and everything, but one or the other is not doing 100% of their activity in some other related field or unrelated field. So
Hmm.
allows the spouse to stay at home, to watch these kinds of videos, to go out and research, to be actively participating in
Hmm.
some of the management of the property, managing the managers, I call that, and documenting all that. And so as long as you've documented it and you had your 15 hours a week
Hmm.
or thereabouts, that's up to 750 hours, and then your 50% of income producing activities have to be in the real estate type of related activities. So that's why you can't
Hmm.
work 40, 50 hour a week job and also claim that you're working 40 to 50 hours a week in real estate. So that's how
That is
the
correct.
IRS. So if they're both working, I'm sorry, it'd probably be a little bit more difficult to make that happen. So
Right. And so really
somebody
quick,
has
another
to
thing.
stay at home.
So you remember I told you about that net investment income tax?
Hmm.
Being an REP is the only way that you can avoid that net investment income tax.
So
So that's why.
tell me that. What was that?
So the net investment income tax, that additional 3.8% on top of the capital gains, that's
Uh-huh.
what you can avoid by if you are a real estate investment professional, you can avoid that additional 3.8% of net investment income tax on any of the properties that you have. So,
Okay. Okay. Awesome. Um, so one more, let's see, one more thing. Estate planning. So for instance, my father-in-law, he's still with us. He's just turned 85 last week. So he's out there
mhm,
still buying real estate. I go, why do you do that? You got, 8-figure estate. He goes, it's what we do. It's like, okay.
mhm.
So, but anyways, someday when our parents are heading out to the pearly gates, we get what's called the heirs get a stepped up basis. Can you explain that?
Yeah, so essentially the stepped up basis is just an opportunity and a way for you to avoid capital gains tax by passing it on to your heirs, right? So essentially, let's say if you purchased let's just call it a stock for $100, but the stock was 150 by the time that the decedent pass it on to the heir, right? You get a stepped up basis of that. So you get the stepped up difference in between is where the real taxation comes in. So you're saving on that additional stepped up basis, and it helps you as the heir to continue that legacy on. And essentially, that's the same thing that you can just continuously do. You can then take up the difference of your inheritance, roll that into an estate plan. That plan can then be stacked out amongst your kids. It can be, sent out at any given time that you want to, whether they're 18, 21, 30, 35, it doesn't matter, right?
Mhm.
So there's just multiple layers inside of that estate planning that can help you.
So the bottom line, though, is that if my in-laws, my father-in-law, sold his 8-figure portfolio the day before he passed it all, he'd have to pay all the capital gains, he'd have to pay all
That
the
is correct.
depreciation, he'd have to pay
Hmm.
the recapture, all that, and it would cut the estate in half just from the
Hmm.
from all the years that he has not had to pay the taxes due to depreciation, what have you. But after the day after he passes, the heirs get a stepped up basis, which means the value of the
Hmm.
property at that time, the
Hmm.
depreciation clock starts all over again, right? For the heirs,
That is correct.
27 and a
Yep.
half years, or they can sell
Hmm.
it without having to pay the gains.
That's
So
correct.
it's a really cool legacy plan. I know a lot of our cultural buyers are Far Eastern. They're really focused on generational wealth. And so this
Hmm.
is one way that you can really build generational wealth, have your tenants pay off these properties along the
Hmm.
way, and then bequeath it to your kids and grandkids
Yep.
with a stepped up basis where they won't have the tax hit that you would have. So that's really a nice thought.
Yeah.
um, so talk to me a little bit about LLCs. We have a lot, especially our California friends that they want to put their properties in LLCs, but I think the state of California charges $800 a year just in fees
Hmm.
just to have an
Just in
LLC.
fees.
So what and it changes the tax picture for the investor, right? As opposed to being in their own personal thing, it's a separate entity as an LLC, and it can affect the end result, right? Tell me a little bit about that.
Yeah, I mean, it definitely can. So there's a couple different layers, right? Number one, most people do it for protection purposes, liability, right? So the liability separates. If somebody wants to sue you individually, they're going to try to sue you for everything that you have. Well, if it's not in your name, they can't sue you, right?
Mhm.
That's the same way about putting the properties inside of a trust and then putting that trust inside of an LLC. That's a better layer of doing it. That way, it's out of your name and it doesn't count against you. But from a taxation standpoint, could it affect you from a tax standpoint? Yes, absolutely. Now you have an additional LLC that's going to have some type of profitability. But depending on how you create an LLC and whether you transfer that over into an S corp, and then how you do a bunch of different tax minimization strategies and opportunities, the taxation really looks like this, right? If it's in your personal name, you got to pay taxes on it if you make a profit for it. If it's in a business's name, then quite naturally, if it's an LLC that's not a single member LLC, so it's a partnership or an S corp, then you pay no taxation on that profit because then it will roll over, right? It rolls into your personal taxes depending on what's left of it.
Okay, awesome. So that definitely want to check with your CPA or check with King before you put your properties into an LLC to see how that might, if everybody's situation is different, right?
Absolutely.
Okay. So there were a couple other things that some of the things that the rich and famous know about, and that's what I asked my advisor, because he does Wes, he works with people that are way more wealthier than me. So I said, Wes, what do those wealthy people do that I'm not doing? That's what I want
Hmm.
to know. He told me about the rent your primary home, which we did last year, employ your children, and then the 469 self rental for business owners that are buying the property.
Hmm.
Just kind of touch on those, and anything else that we missed that would be a really good reason to give you a call.
Yeah, no, I'll definitely touch on a couple of those. So number one, the Augusta rule, which you're talking about, right? Renting your
Yeah.
home 14 days out of the year. That money can be put over to you tax free. I actually have an app that builds out an algorithm that just essentially says, hey, what's the zip code? What is your home type? And what's the square footage? And it spits out everything that's around you that will say, hey, the cost is going to be this. This is how much you should pay 14 times a year. So if it's $1,000, per meeting, that's $14,000 that you can have, right?
It's basically
We also
taking your
kind of
house
teach you.
and renting it to your business for 2 weeks. So you get the income rent from your business, but you don't get taxed on the income.
Correct, because it's tax free. Absolutely. We also teach various strategy of how to, rent your own personal vehicle to your business, right? If that's something
Right.
that you have as well. If you got multiple vehicles, you can do up to two, right? If you have a spouse, well, you can possibly add in another one. So that's an opportunity. These are key things that a lot of people just don't know how to do. They've heard about it, but they don't know exactly how to do it. And that's where we kind of
That's
teach.
awesome.
Paying your kids is very important. Okay. Paying your kids is absolutely one of the most important things that you can do. The IRS looks at that as favorable. So if your child makes less than $14,000 a year in your own company, there's two different things I'm going to teach you right real quick that you can do. Number one, you can put that, half of that money into an Roth IRA for your kid. Number two, the kids can gift that money back to you and it's tax free. You can gift anybody in this world $17,000. Okay. Remember, I just said you can pay your kid up to $14,000 a year, no taxes
Mm,
on it, just Medicare and Social Security.
right.
Half of that it can go into a Roth IRA for your kid and let it build up. The other half can be paid out to you directly as a gift. So essentially, you just kind of save yourself a lot of money there, right? One of our clients has 7 kids. Imagine how much money he's saving
Seven kids.
there.
Well, it's kind of fun because
um,
I did it
yeah,
last year, and I told Julia, you're paying for your own school this year. She's like, what? Because we had private school.
yes.
So, but
Right, right.
yep.
Then you go deeper in savings. You got solo 401ks. That's an option. You were just talking about, 469C, which is a section that essentially just provides a passive it provides a layer of non-taxation for passive activity on an individual that is doing what's called a self-rental, right? Now, there are various traps in there that you do need to avoid. I'm just kind of looking at right now, right? It's certain losses, the sale of an operating lessee company. Those are things that you got to think about as well. But ideally, I like the rental for trades and uses that are going to give me the amount of income that I'm looking for, but where I don't have to take the taxation on it.
So
So,
basically, the company is buying the building it's in rather than leasing it. Is that an
correct.
example? Okay.
That
So
is correct.
then they
Yep.
can
And then,
lease
of
it back,
course, you can
create a
inflate that
loss,
rent.
right, and
Hmm.
create income tax free from it.
That is correct. Yes.
All
So
right.
again, there's a number, right? There's a number of different strategies that we utilize. Everything from a beneficial trust, which allows you to pay your own bills, right? By using the trust itself, you sell everything to the trust. The trust then pays the bills, so you have no bills. That money's just rolling through. Again, we could talk about this stuff for days,
I
but
know.
there's so many different layers.
Well, and I just didn't know it. And even just today, talking to my financial advisor and talking to you, I've learned stuff that is going to be helpful for my clients. And so it's a lot of the big things like 1031s and primary residence, that's a lot of it. But then all these other really deep dive stuff that I've just learned over the last few years, even though I've been doing this for 40 years. So it's
Yeah.
great that's why I build a network of help that is an experts in what they do. I've my podcast
Hmm.
experts interview and also the investor savvy agent because most investors, most realtors don't really do investment property, or nor they
Hmm.
own it. And so we put together a network of experts that are proven, that have been doing it for a long time. Maybe somebody has 2 PhDs, and so to be able to help you navigate the waters so that you can. And this best to be done right when you're setting up your investment strategy, not when you're deep down
Hmm.
into it or end up with a sticky situation down the road.
Right.
So, King, I appreciate your time, and definitely would like to put the information out there of what get your contact info right now. We'll go ahead and do that. I'll put that in the video as well. So, what's your best way to contact you?
So, best way to contact me is obviously you can go to our website, www.theaccountinglab.co. You can reach me by phone at 407-405-7535, or you can send me an email at kmccray, so kmccray at theaccountinglab.co. More than happy to talk to you.
All right, appreciate you taking your time, and I'm looking forward to you doing my tax returns, and I get that refund for the amount of money that I shouldn't have put into the last year. So, thank you so much, and love to see if you think you can prepare me for that audit, so I can go back to 2021 and cover my taxes from there, from
Let's do it,
2 years
brother.
ago. All right. Well, thanks a lot. Thanks for being the expert. Thank you for your advice, and I look forward to the webinar coming up. All right. Talk to you soon.
Thank you. Yep.
Have a good day.